Welcome to another episode of Getting to Know Asset Class. Today, we will be looking at one of the favorite asset class for investors looking for passive income. So what are REITs and how do they work? What are the different types of REITs? Why should we invest in them? What are some of the risks? And how do we invest in REITs? Okay, let's take some time to answer these questions. REIT is an acronym for Real Estate Investment Trust. It describes a company or business set up for a very specific purpose. Now, imagine you have some spare cash and you are looking to invest in a house for rental income. You can either do everything yourself or you can hire a real estate agent to hunt for that ideal house for you. You pass her the cash and she will use that cash to buy the house. She will also look after the maintenance of the house as well as being responsible for finding the tenants. The agent will then pass on the rental income from the house, net of all maintenance expenses, to you. And in exchange for all the work that she does, she will take a cut of the rental income as her fee. It is exactly the same for REITs, except the scale is much larger. Instead of an individual, we now have a group of investors who are looking for income. They invest their money in a REIT which is managed by professionals. They use the money to buy up income-generating assets. They also become the managers of these assets, making sure the assets generate as much yield as possible for the investors. Okay, then they will pass on the income net of expenses to the investors by way of regular dividend payouts. The REIT will charge a management fee, which is part of the expenses taken out from the income stream. Okay, so the structure for most REITs are essentially the same. The only difference is the type of underlying assets owned by the REIT. The assets can be anything as long as they generate income. Let's look at some examples. A commercial REIT can own shopping malls and office buildings. A hotel REIT can own standalone hotels or hotel chains. A medical REIT can own medical facilities such as hospitals, clinics, or even hospices. Infrastructure can also be attractive to REITs because of the tolls and fees that can be collected, and infrastructure is generally seen as essential. All right? So in the modern data-driven world, data center REITs are also becoming quite common. What are some of the advantages of investing in REITs? REITs can offer stable cash flow by way of regular dividends, and the yield tends to be higher than a typical company stock. Okay, and unlike owning a single property as an individual owner, buying a REIT allows you to own a diversified portfolio of underlying assets. If you're trying to buy or sell a single property, you know that it is not so straightforward because you need to find some interested party first, right? REITs, however, are typically liquid as they trade similarly like stocks on the exchange. You can easily buy and sell on the exchange without needing to find someone to trade with you. REITs offer a fair amount of transparency since the company behind the REIT is regulated by the exchange and is required to be transparent. They publish annual reports just like any publicly listed companies, which will detail all the financial information related to the assets as well as the company itself. Now, VNQ is a popular US REIT, so I've used it here just to illustrate the correlation between REIT and stocks as represented by SPY. So as you can see, they are positively correlated, but the correlation is not perfect. All right, so REITs can also offer some diversification away from stocks. Now, what about the risk? As mentioned earlier, REITs are positively correlated to stocks, hence it tends to go down during a stock market crisis as well. And secondly, REITs are also highly sensitive to interest rate, okay, due to the fact that the returns are purely derived from fixed income. Okay, so therefore, when interest rates go up, the REIT's fixed income become less attractive in comparison. Therefore, REITs prices tend to go down when interest rates go up. And a REIT is only as good as the manager responsible for the REIT. So if the manager's interest is not aligned with the investor, things can go wrong quickly. Now, what are some of the ways that you can buy REITs? So you can simply buy them directly, just like how you go about buying a stock. But if you want some expert overseeing your REITs for you, you can buy REIT mutual funds. However, these mutual funds add another layer of fees that you need to pay for, all right? Now, with the development of the ETF market, there are a number of REIT ETFs that you can also consider. Some of these are actively managed, just like a mutual fund, while some are just passive baskets of underlying REITs, and typically they cost less. Now, you can refer to the link below for a list of REIT ETFs. All right, so this is just a brief introduction to REITs, but I hope you have gleaned some useful knowledge from this video. Do smash the like button and subscribe to our channel where we will constantly produce new relevant videos on investing. And also, AllQuant conducts courses on investing, so if you are interested, you can just visit our website for more information. All right, I'll see you at the next video.